this is not going to be a fast recovery. This will take quite some time, quite some months before we can think about anything that looks like normal. The fiscal and monetary policy is now being applied. And you rightly say we got to see how effective it's going to be. In certain cases, it will take time, in particular fiscal stimulus, for it to work through the system. We have a situation in Hong Kong whereby money will be released to individual households, but it will take some time before we actually get it. I think that's due in July. So these things will come with a bit of a time lag. The monetary policy impulse, that translates into market action a little bit faster. The good thing is that we don't have, and this is unlike what we had in 2008, we don't have a banking system that's completely frozen up, whereby liquidity between banks is a major problem. So hopefully the monetary transmission is going to be a little bit faster than what we've seen, for example, 10 years ago in the 2008 crisis.
When it comes to an equity strategy then, do you have one in this environment, given that markets have been so volatile and there's very little clarity out there when it comes to the earnings picture for 2020, and we're likely to see that further evidence of that this week when companies, of course, releasing quarterly numbers are likely to withdraw guidance for the whole year. And we've already been seeing that in a number of markets around the world. Yeah,
so obviously we always continue to monitor what are the key equity drivers. So you think about valuations, earnings growth, and these kind of things. But there's an extreme high degree of uncertainty to it. What you need to watch at the moment as well is the ability of governments to be able to cope with the situation. For example, here in Hong Kong, we have plenty of monetary but also fiscal stimulus, room for fiscal stimulus that can be implemented. In other countries across the region, that will be much more difficult. India and Indonesia, amongst others, fit that. So that's one way of looking at it. Another way is that we've tried to establish a new set of a new toolbox in order to look at markets by looking at what we think over time, what the speed of the recovery could be, and what the changes might be in industries that could take place. And from there on, we try to also assess what industries look interesting and which one maybe a little bit less so. So we're trying to broaden our toolbox as well in order to come to some kind of equity strategy.
Well, what does look interesting and what doesn't look interesting then?
Well, at the moment, I think there's a couple of markets that look interesting. There are a couple of markets across the region that trade at multiples that are pretty much close to where we were in 2008. Hong Kong is a primary example for that. So that is a market we like purely on valuations. And also, as I mentioned, the ability to cope with this crisis is actually pretty good in Hong Kong. Fiscal stimulus is, there's plenty of room for them to do so. We like China as well. Valuations are maybe a little bit more elevated there, but of course growth is starting to come back. We're getting good sounds and noises coming from corporates there. So that's something we like as well. And there's another market that is also looking quite cheap. It's much smaller, and that's the Philippines. So those are the three markets that we like at the moment.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.